Is it possible to get stock market returns without stock market risk? I ask this question when I lecture at the universities, and I always get the same answer. 100% of the students say absolutely not. Well, we know that the S&P 500 gives us high return, but it also gives us high risk. We also know that if we put our money in a short-term investment, like a short-term bond fund, Vanguard, Guggenheim, whatever short-term, ultra short-term bond fund, doesn't have much risk, doesn't have much volatility, but doesn't have much return. But what if I can get the risk of the short-term bond fund with the return of the stock market? Would that be exciting? That would be very, very exciting. Well, let's examine that for a minute. Let's talk about, over the next couple of minutes, what stock replacement is. One of the strategies that we use at our firm. It's quite simple. As I tell my students, it's not magic, it's just math. Here's what we're going to do. What if we took the present value of the future cash flows of this bond fund? We looked over the many years and said, okay, it's, in this example, let's say it's kicking off 2.75% So let's take the present value of that future cash flows and let's use that to buy a simple call option, exchange-traded call option. And this exchange-traded call option is regulated by the OCC. It's never had a default, very liquid. If I then took the future interests of this exchange-traded bond fund, let's say call it Vanguard, ultra short-term bond fund, and I said, okay, I think it's going to return, historically returns, let's say 2.75%. And I took that money and invested it in a call option. In fact, the only risk in a call is the cost of the call. There's no default risk, there's no counterparty risk because it's exchange traded. The bottom line is, if I took the future cash flow, the present values, and I invested in call options, then I'm paying for that call. What we've done is we've eliminated the cost of the call. Essentially, now I could get stock market returns without the risk. What does that mean? If the market goes up, I don't participate in the upside. The market goes down, I'm going to lose nothing on the downside. I'm getting the return of the market exposure with the safety of a short-term bond fund. So where is all the risk? Well, the risk actually is in the bond fund. That's where all the risk lies. Now, if I did that today, as I make this recording, and I invested 2.75 in a one-year call option, because I want these things to be short-term, because I want to lock in these returns when it goes up, and I don't want to participate when it goes down. How much of the market can I capture? Well, based on the mathematics, you can capture about half the market. Student says to me, yeah, but you're only getting half the market. Market's up 10, you're only up 5. Market's up 20, you're up 10. I say to the student, 95% of investors are in a 60-40 stock bond mix. Historically, over a market cycle, a 60-40 stock bond mix gives you about 44% of the upside. About 44% of the upside. Problem is, it gives you about 50% of the downside. It's not acceptable. If I go into a stock replacement strategy right now today with zero cost, I can capture 50% of the upside. That's not 50% worse than the market. It's 6% better than the average investor. That's in a 60-40 stock bond mix. By the way, Merrill Lynch just came out with a study saying 60-40 stock bond mix is not going to hedge you in the next bear market. It's pretty scary because that's where most people are real happy about the returns in 19. 60-40 had the best year in 20 years. Everybody, $400 billion came out of equities into bonds. Bonds rallied, but international money started flowing into equities. Share buybacks from the 2017 Trump tax cuts. That spurred the market higher this year. So you had a convergence. Stocks and bonds went up. Best year in 20 years for a 60-40 stock bond mix. But Merrill Lynch says not going forward. Merrill Lynch says market goes down, 60-40 is not going to work. Why? Because there's no upside. Interest rates are getting near zero. $17 trillion globally are negative interest rates. So we go into a stock replacement strategy where we invest the money, most of the money in short-term bond fund. We take the future value of the interest, we buy call options, we calculate our participation rate. Right now, today, 50% of the upside. No risk, no downside, no cost. Downside is, all the downside is in the Vanguard short-term bond fund. Why would anybody take the risk of the market if you can get the market returns without the downside risk? It sounds too good to be true. That's what stock replacement, one of the strategies that we use at IPS Strategic Capital.